Good morning and welcome to today's webcast, Boost Cash Flow. Before we begin the presentation, I'd like to play a brief housekeeping video.
Moss Adams is pleased to present another in our ongoing series of continuing professional education webcasts. Our presentation will start in a few moments. Before we begin, here are a few things to keep in mind. You can customize both how you view our presentation and how you interact with the presenter. For better viewing, close all other applications and turn up your speaker volume. You can also adjust window size and placement. At the bottom of your screen, you'll see a series of icons, each relating to a different aspect of our session. For example, you can click the file folder icon to download the group attendance sheet and a PDF copy of today's slides. You can ask our presenter questions during the webcast by clicking Q&A in the bottom left-hand portion of the icon bar and typing in your question. We'll do our best to answer all questions during the presentation or follow up via email. If you experience technical difficulty during today's presentation, refresh your browser by hitting the F5 key. We'll ask polling questions throughout today's presentation. Per the National Association of State Boards of Accountancy Webcast CPE standards, CPE credit will be awarded based on your participation in these polls. To respond to a poll, click the button next to your answer. If you're attending this webcast in a group, in order to receive CPE credit, you must complete our attendance sheet, available in the file folder icon at the bottom of your screen. Please have all group members sign the sheet, and please remit only one sheet per group. Also note, today's session will offer you one CPE credit. To receive credit, you must meet the requirements as specified by the National Association of State Boards of Accountancy. CPE credit can be awarded only to participants registered as themselves and is not available to participants who view the on-demand version. We'll track your progress and alert you when you've earned CPE credit. You can then click the certificate icon to open a PDF file you can save to your computer. We'll email a copy of your PDF certificate in 2 weeks if you can't download it today. As a reminder, the presentation you're about to see is not legal, investment, or accounting advice. We encourage you to seek the counsel of a professional service provider to apply this content to your specific circumstances.
Thank you for joining today's webcast. I'm Star Fischer, a partner in Moss Adams. I work with companies of all sizes and in all industries that claim the R&D credit. With me today are my two colleagues from Moss Adams, Travis Riley and Anna Ferraro. Travis is a leader in the firm's R&D tax services practice and has a lot of experience with companies in the technology and life science industries. Anna is a leader in the firm's state and local tax practice and handles California and multi-state sales and use tax transactions for companies across industries. Before we jump in, we'd like to get a sense of the size of businesses on this webcast. This will help us customize the presentation where possible. So with that, we have our first poll question. Please note that there are more poll questions than typical in this presentation. In order to receive CPE credit, you'll just need to answer 5 of the 7. So the first question is, my company's annual revenue for 2016 is expected to be no revenue, up to $5 million, $5 to $10 million, or over $10 million. I'll give you a few seconds to answer here. Okay, about 5 more seconds here, and I'll close the poll. All right, it looks like we have some larger companies here on the webcast, about a little bit more than half. So, some of the items covered today might apply more to the smaller companies, but we will cover some that are still beneficial to the ones over 10 million. For the webcast today, we'll be looking at specific opportunities that can help free up funds for companies with little to no revenue. Many of the items also apply to companies with more revenue, just in a different way. Again, to learn a little bit more about you, we have back-to-back poll questions. And again, you just need to answer 5 of the 7 to get CPE credit. My company primarily operates in the following industry: software, pharmaceutical, clean technology, medical devices, or other. Okay, about 5 more seconds and I will close the poll. All right, looks like most of you are other, so a little bit harder to customize, but we'll do our best. Next question, my company has the following number of employees: 0 to 10, 10 to 20, 20 to 30, 30 or more. Okay, close the poll. Okay, so the majority are 30 or more, with some less than that. Thank you for that input. And that brings us to the first section of our presentation, federal tax savings opportunities. We'll start with the PATH Act, which was enacted December 18th of 2015. It contained a few key items related to the R&D tax credit. First was the permanent extension of the credit. It had been temporary, expiring every 2 years up until 2016. Now it is permanent. There's also alternative minimum tax offsets for eligible small businesses, which is new, and a new payroll tax offset for qualified small businesses. With that, I'll hand it over to Travis Riley, who will cover the payroll tax credit portion.
Thank you. So for the past 34 years, the R&D credit has only been available to companies that are profitable. So that means that a lot of small and medium-sized companies have historically been left out completely. Mostly, we're talking about companies that raise money, spend it all on engineering or R&D, and then hope they hit it big when it comes time to finally launch a product. Most of these companies have never benefited from the R&D credit because they're not making any money, and so they're not paying any federal income tax. Sounds like I'm talking about your company, and I have some really good news for you. So thanks to the new PATH Act, there are some new rules that will allow eligible companies to cash out their R&D credits and use them against payroll taxes. And as you know, any company that has employees is paying payroll tax. Now, if you qualify, you're looking at savings of up to $250,000 for up to 5 years. So we're talking about millions of dollars in tax savings for companies with the right profile. But in order to qualify for this incentive, there are really 3 core requirements that you need to meet. Number 1, you have to have gross receipts for 5 years or less. That means that a company isn't eligible if it had gross receipts prior to 2012. Number 2, you have to have less than $5 million in gross receipts in 2016 and every other year that you elect the credit. Number 3, you actually have to have R&D credits to cash out. And in order to have R&D credits, you have to have qualified research activities and qualified research expenses. So one of the most common questions that we're getting from companies is, when do these new rules take effect? So here's how it's going to work. First, you need to claim the R&D credit on your 2016 federal income tax return. On that return, you need to specify how much of it that you want to elect against payroll taxes, up to the $250,000. Then after you file that return, the credit is going to carry over and offset payroll taxes in the following quarter. So for example, if you file your tax return by March 30th, 2017, then your credit would be applied against payroll taxes in the second quarter. So we're talking the April, May, June timeframe. The payroll return that applies to that quarter won't actually be filed until July. In fact, it's not even due until the end of July. But long story short, the earliest that companies will receive a cash benefit is July of 2017. And that's only if they file their federal income tax return by the end of March. What I've been telling companies is that they probably won't see a benefit until about 4 to 6 months after they file their federal returns. So some companies may want to consider filing a little early next year to accelerate the cash benefit. So who qualifies as having gross receipts for 5 years or less? Like I mentioned earlier, if you've had gross receipts prior to 2012, then you're not going to qualify. I think that part's pretty obvious. But what happens if you were in business before 2012 and you didn't have any revenues? Maybe you've never had revenues. That's a question that's been coming up a lot. As the rules are currently written, companies that fit this profile could still be eligible. In fact, many well-funded life science companies could qualify under the new rules, and these are companies that spend a lot of money on research and development. But then this also leads us to another very important question, and that is, how do you define gross receipts? Now, what I'd like to do here is home in on bullet number 4, and I'd like to provide an example because I think it's important. I had a client reach out to me recently, and they wanted to know if they qualify under the new rules. This is a company that started in 2010, but they've never had any sales. They've incurred significant R&D expenses every single year since the company's inception. So what I did is I pulled up their 2010 return, and they had reported something like $200 in interest income for the year. So naturally, the question is, does the interest income count as a gross receipt? And if so, would this rule them out? Now, the answer to that question is, well, it depends. There's currently 2 conflicting sets of rules, and it depends on which rules you want to follow. Under one set of rules, this company would qualify. Under the other set of rules, they would not. So I like to say this is really the million-dollar question right now. IRS, they're supposed to provide guidance on this by the end of the year. In fact, just last week, a group of senators sent a letter to the IRS asking them to get going on this, and they were very clear that they want the IRS to provide maximum access to the credit. But in the meantime, we're just kind of in wait-and-see mode. One other thing I should also point out here is that the gross receipt threshold of $5 million only applies to the year that you're claiming the credit. So in other words, you could have had $7 million in gross receipts in 2015, but then if you drop below that $5 million mark in 2016, you could still be eligible. Okay, so what are qualifying activities? One of the requirements I mentioned in the beginning is that you need to have R&D credits in order to benefit from this. This means you have to have qualifying activities and qualified research expenses. I'd like to touch on those points just briefly. A significant portion of tech, life science companies, and many other companies that I talk to are going to meet these requirements. If your company is developing new or improved products, processes, or software, if you hire engineers, scientists, or any kind of technical personnel, then there's a high likelihood that your activities are going to meet the 4 tests outlined here in this slide. One thing I do want to point out is that there is an additional set of requirements that would apply to companies that develop internal use software. Let's talk about what types of costs are eligible. Qualified R&D expenses generally fall into one of these 4 areas. Number 1, we're talking wages. It's wages of those who are doing the R&D, as well as anybody who is directly supervising or supporting the R&D efforts. Number 2 is supplies. These are supplies that are used in the R&D process, but will not include any supplies for G&A or depreciable equipment. Number 3, amounts paid to subcontractors. And here we're talking about subcontractors who are performing research in the United States. And number 4, amounts that you pay to cloud service providers, like let's take an AWS for example. Those costs could be eligible if they're directly related to your R&D efforts. So now that you know what expenses qualify, let's talk about how those expenses translate into an actual credit. What you'll want to do is add up all of those expenses that we highlighted on the last slide. And for most companies, the federal credit is going to be equal to about 10% of those expenses. So for example, if a company has $500,000 in qualified research expenses, you could have a credit of roughly $50,000. So you will need to make some elections on your original return if you want to use these credits to offset payroll. And when I say original return, that does include any extensions that you may file. So now that we've talked about how the R&D credit is calculated, let's talk about how you can actually use it if you're not paying any income tax. First of all, any company that has employees is going to be paying payroll tax. And if you qualify under the new rules, the R&D credit can offset the employer portion of Social Security tax. That's 6.2% of an employee's salary up to $118,500. So for highly compensated employees, you could be paying over $7,000 per employee. If you take this, you add it all up for all of your employees, this is the total amount of payroll tax the credit could offset. So you would need somewhere in the neighborhood of 35 or more highly compensated employees to use up the whole $250,000 as an example. Any credits that you can't use up in a given quarter, they're going to roll over to the next calendar quarter, and they should keep rolling over until you use them all up. One other thing I want to mention here, we do have some clients that use third-party providers to manage their payroll processes, and we have reached out, we've talked to some of the larger providers, and what they've been telling us is that the way they're going to pass this benefit back to their customers is through the use of invoice credits. Okay, so real quickly, I just wanted to highlight some of the key differences between the old rules and the new. And really the main difference I wanted to draw your attention to is the very bottom line. Under the old rules, a company with $2.5 million in R&D costs and $4 million in payroll would get a credit of 0 if they don't have any federal income tax liability. However, under the new rules, a company with that same scenario could offset almost $250,000 in payroll tax. So I've talked a lot about the potential benefits under the new rules, but I'd also like to talk about the IRS and how they actually regulate R&D credits. And the main point I'm trying to make here is that once you start using credits, they are frequently audited and they're highly scrutinized by the IRS. In fact, anybody who's been doing this for a while is going to tell you R&D credits are near the top of the IRS's radar. And it's been that way for a really long time now. Some of the companies I've talked to, some of the tech and life science companies are already claiming a credit on their return every year. But sometimes when you take a closer look at it, what they're really claiming is essentially just an estimate. A lot of times there's very little documentation to back it up. In the past, nobody's really cared all that much because a lot of these companies are in losses. They're not going to use the credits anytime soon. They might never use them. But when R&D credits do get audited and the company doesn't have the right documentation in place, it is common for the IRS to deny the credits and charge 20% penalties on the amounts claimed. And this is becoming the standard now on almost every audit. The IRS has their own team of agents that specialize in the R&D rules, and these people are eager to poke holes in R&D credit claims. So, how do you properly document the credits? Well, there is no real one-size-fits-all approach, and it really depends on your industry. I saw one of the initial poll questions. It looks like we have a variety of companies from all different industries. So those standards are probably going to apply different to each of the companies that are listening in. I could probably spend an entire hour talking about how to document your credits, but I could probably save that for another time. However, I would strongly encourage companies to talk to someone who knows the rules well. Make sure that you're talking to people who are dedicated R&D professionals and people that have IRS experience. I just want to say for any tech or life science companies on the call, I encourage you to visit the IRS's website. Take a look at their audit guides. They're mentioned here. These are fairly comprehensive guides that provide a roadmap to IRS agents who audit R&D credits in your industry. So what are some of the key takeaways here with the payroll tax offsets? Number one, if you qualify, you can claim up to $250,000 a year for up to 5 years, which caps out at $1.25 million. Number two, this is something that you need to elect on your federal income tax return, and then this is something that you can use when you file your quarterly payroll tax return. Number three, you need to act soon if you want to accelerate your cash benefit. So that means you'll need to file your return by March 30th if you want to receive a benefit in July. And then number four, credits should be quantified and documented by an R&D tax credit professional. That leads us to our next polling question. And the question is, I believe my company would qualify for payroll tax offsets. Yes, no, or maybe. In just a few more seconds. Make sure you hit that submit button too when you're done. All right, so it looks like there are some yeses and some maybes and quite a few nos. So for the yeses and maybes, I'd like to talk with some of you, and I think our contact information is probably posted here at the end of the presentation, so feel free to reach out. All right, off to Anna, or Star, I'm sorry, Star.
Right, so we're covering the Arizona and New Mexico R&D credits in this presentation because both of these have opportunities for companies that are not paying income tax or do not have income taxable currently. The first is the Arizona refundable R&D credit. So Arizona has a standard R&D credit, a non-refundable credit. It's actually the highest in the nation. So many states have R&D credits that mirror the federal credit, but Arizona's is the highest and most beneficial. There are some exceptions from the federal credit in that it only includes Arizona gross receipts, and it's not included in taxable income. The federal credit can be included in taxable income in some cases. The refundable portion of the R&D credit is available to companies with fewer than 150 full-time employees. This one is different in that you have to apply for the credit on a first-come, first-served basis. So what we are seeing is we are filing a whole bunch on January 1st of each year. There's only 5 million that the state gives away, and so the first to get the applications in are the first to get the credit allocated. It is refundable, so you do not need to be paying any state income tax to get it. You just need to apply very quickly, as it does run out within the first week of the new year. And we have a quick poll question on this. The refundable portion of the Arizona R&D credit is available to companies with fewer than 150 full-time equivalent employees. true or false. I'll give about 5 more seconds here to answer. Okay. Most of you got it right. The answer is true. It is available to any company with less than 150 full-time employees. The New Mexico credit is known as the Technology Job Tax Credit. Very similar rules, though, to the R&D credit. It is quite a bit broader than the federal R&D credit, and it offsets more taxes. So as I mentioned, you don't need to be paying state income tax to qualify. It can be used against the state gross receipts tax, compensating tax, and payroll tax. It's very valuable to companies that are startups or tax exempt because they're not paying any income tax. It does need to be filed within 1 year of the end of the year where the credits are generated, so you don't have the same 3-year look back that you might have with the federal credit. And every application is audited. So it does get a review by the state, which is good and bad. You know, before you get your refund, it gets audited, so you know that once you get your refund, it's good. You don't have to worry about it being taken away, but you do have to go through that audit process. For 2015, the amount of credit is 4% of qualified expenditures. For 2016, that has changed to 5%, so more lucrative. And if it's not being able to be used in 1 year, it does carry forward. So if you don't have enough tax to actually use it, it can carry forward. And additional 4% can be used against income tax if you are paying state income tax, if you are proving that you're increasing payroll in the state. So it could potentially be an 8% credit. For New Mexico, the eligible expenses include everything on the list here. It's much broader, again, than the federal R&D credit that just includes labor, supplies, and contract research. Next poll question. New Mexico's Technology Jobs Tax Credit can be used by all businesses, including startups. True or false? I'll give everyone some time to answer here. Five more seconds. Okay. And majority of you got it right. The answer is true. It can be used for all companies because it can be used to offset different types of taxes, regardless of whether you're paying income tax. Now I will turn it over to Anna to cover California.
Thank you, Star. And we are going to start with a polling question as well. Do you expect to purchase equipment for R&D? Yes, in the next 1 to 2 years. Yes, in the next 3 to 5 years. Or no. And we're going to give it 5 more seconds before we close the poll. Please make sure you hit submit after you vote as well. Okay. And it said most people are, actually pretty soon. Well, actually most people are not, but there's a good portion of you will be in the next year or two. And that's where this the California sales tax partial exemption comes into play. So a partial exemption for equipment purchased for use in R&D and manufacturing activities went into effect on July 1st of 2014. This partial exemption cuts the sales and use tax rate by almost 50%, in some cases more than 50%. The partial exemption reduces the sales and use tax rate by 4.1875%. So a business in an area with an 8% tax rate would pay 3.8125 under this partial exemption. The partial exemption is for R&D or manufacturing activities for persons primarily engaged in activity described in one of the following NAICS codes. 541711, which is for research and development in biotechnology, 541712, research and development in the physical, engineering, and life sciences, and 3111 through 3399, which are manufacturing activities. This exemption applies to purchases or leases of equipment that have a useful life of at least 1 year. So unlike the R&D credit, consumable items do not qualify for this partial exemption. The partial exemption can also be used for construction of special purpose buildings or structures, and it doesn't need to be complete construction. So if you're doing remodeling and there's, say, process piping that's used in a qualified activity, that could also qualify. Eligible purchases are capped at $200 million per year. So primarily engaged in activity means that at least 50% of activity must be described in one of the above NAICS codes. However, a company's primary business activity does not need to be in R&D or manufacturing. Rather, a business that has any activities that would be considered R&D or manufacturing could qualify for the partial exemption. This means that a business that has a separate cost center, a division, a physical location that are engaged in R&D or manufacturing activities can qualify for the partial exemption. However, only the items purchased for use in that qualified activity would qualify for the partial exemption. So, for example, a repair company, on its face, is not one that would qualify for this partial exemption. However, if that repair company has a shop that develops no tools that it can use in its business to better serve its customers, the work done in that shop can be isolated as a separate division or cost center. In looking solely at the shop, its activities can be considered R&D since its activities are engineering in nature and they're designing and creating new tools. So things such as computers, software, tools used in creating the new tooling, and other items used in that shop could qualify for this partial exemption. So how do you determine if an activity qualifies for this partial exemption? There are many options of determining the qualification. So you can look at gross receipts. It has to be 50% or more of one of these items. So you can look at gross receipts if you're a company that has no gross receipts, operating expenses, prior year employee salaries, the number of employees working in activity, or just some of the ways that you can look at whether or not that activity qualifies. So there are many options in this area. The repair shop in my example would not have gross revenue since the work is done internally. So therefore, they may look to expenses or possibly employees to meet that qualification. I strongly recommend documenting how or why a business unit, entity, enterprise, or any type of activity qualifies for the exemption. And documentation can be something as simple as a brief note, an email, a spreadsheet with calculations, or even a formal memo put into your sales tax file. That way, if you are audited down the road, you do have documentation as to how this activity qualified. Once you determine if an activity qualifies, you need to look at what equipment is being used and whether that equipment is used in an R&D or manufacturing activity. To qualify for the partial exemption, the equipment itself must also be used at least 50% in R&D or manufacturing. Documentation should be maintained on items that are used both in qualifying and non-qualifying activities. For example, if a company purchases computers used for both R&D and administrative purposes, documentation would need to support that their use of the computer is at least 50% in R&D. To claim this partial exemption, the purchaser would need to issue an exemption certificate to the vendor. The State Board of Equalization provides blank exemption certificates on its website, and if you purchase an item and you're self-reporting use tax on your use tax return, you need to make sure that when you report the purchase, it's done on the partial exemption section of the California Sales and Use Tax Return. So items that generally qualify for the R&D and manufacturing could be computers, servers, test equipment, tooling, repair parts. Remember, it has to have a useful life of at least 1 year. Certain apportionable trade-in businesses are excluded from this partial exemption, specifically those that derive 50% of their income from agricultural, extractive, certain banking or financing activities. The next opportunity in California is the California Competes tax credit. Cal Competes is a program that provides income tax credits to businesses that are looking to move into California or stay and grow in California. $150 million in income tax credits were awarded to 212 businesses during the prior year, and that amount will grow to $200 million this year. This is a competitive application process with an emphasis placed on hiring and compensation. The purpose of this program is to attract and retain companies that hire Californians and provide them with good wages and benefits. The program is administered by GoBiz. There are 3 application periods each year where companies can apply for the Cal Competes credit. The 3 application periods for the upcoming fiscal year are announced at the beginning of the fiscal year in July. The 3 application periods generally fall about the same time each year. For 2016-27 fiscal year, the application periods are the first one July 25th, 2016 through August 22nd. The next will be January 2nd, 2017 through January 23rd. And the final one will be March 6th, 2017 through March 27th. The amount of credit allocated to each application differs each time. So the next application period began yesterday on July 25th, and GoBiz has $75 million in credits it will be awarding in this period. 25% of all credits are reserved for small businesses, which are defined as having $2 million or less in gross receipts in the prior year. These credits can be spread out over 5 years, and any unused credits can be carried forward for 6 years. Some things to consider when applying for the Cal Competes credit. First of all, start your application early. This will allow you more time to prepare a better application. The application requires you to provide financial projections, and the amount of credits rewarded would be based on these projections. Therefore, it is important that these projections are accurate. In addition to these projections, the application will tell a story about your company. Your story is important since this can help put you above someone who is similarly situated. Keep in mind, you are competing against other companies for the credit. So the better the story of your company and its benefits to California, the better chance you have of being chosen. Second of all, is the timing right? Credits start when the acceptance occurs, so it's important not to apply too early. However, you also want to be able to apply in a subsequent period if you're not chosen. So even if you apply and you don't make it past the first round or you do not get any of the Cal Competes credits, you can reapply the next open period. We do provide free consultation to help you decide when the best time is to apply. So please reach out to a professional if you have any questions on that. Once the application period closes, GoBiz will notify companies whether their application was chosen to move into the second round. In the second round, the applications are more closely scrutinized, and GoBiz is looking for those applicants whose business plan and activities are going to best contribute to the California economy overall. So companies that are good candidates for this program are businesses that are getting ready to expand in California, businesses that are considering moving into California, and businesses that are thinking about leaving California and want to be incentivized to stay in California. And now we'll put it back to Star, who will cover eligible small business credits.
Thank you, Anna. As part of the Act, AMT Offsets for eligible small businesses was put into place. One of the major limitations on the amount of credit that companies can benefit from is alternative minimum tax. The regular credit can only be used against regular tax liability and not alternative minimum tax liability. So for companies or shareholders of companies that are paying alternative minimum tax and fall into the qualifications, this can be a huge benefit. Something similar was enacted in 2010, but it was a 1-year reprieve from paying alternative minimum tax. This starts in 2016 and will continue in future years. So to be eligible, your company has to be not publicly traded and have less than $50 million in gross receipts over the prior 3 years. and that's an average. For those that are eligible, the tentative minimum tax is treated as zero. So the effect of that is that the credit can offset AMT tax as well as regular tax. It also will carry back 1 year and forward 20 years. And again, this applies only to credits generated in 2016 forward. So prior R&D carry forwards would not be eligible. To illustrate an example of how this would work, assume that in 2016 there was an eligible small business credit, R&D credit, of $48,000. The regular tax for this company is $30,000, tentative minimum tax $45,000, which means that the alternative minimum tax is $15,000. The total tax liability in this case would be the $45,000. So under the eligible small business credit rules, you would be able to use $45,000 over the greater of zero, which because tentative minimum tax would be treated as zero, or there's a second limitation, which is known as the 25-25 rule. 25% of the tax over $25,000. So the result here is that the usable credit would be $43,750. That could basically take this company's tax liability down to that $1,250 amount. Here's a comparison of the old rules and new rules. So in the example that we just talked about, the total tax would be $1,250. Under the old rules, this company would not be able to use the credit because of that AMT limitation, and therefore would be paying the total $45,000 in tax. So they saved $43,000 just with this new law. This limitation, although can get a little bit tax technical, does affect a lot of our clients that we work on with R&D credit. So this is a big benefit for these companies for both 2016 and future years. Okay, well that concludes our presentation and leaves us about 20 minutes for questions. If you have any questions to submit, you'll see at the bottom left-hand corner there is a Q&A tab. Simply click on that and you can type in your question and we will route it to the correct person. It looks like we have a few in the queue. We'll start with one that is for Anna. How do we apply for partial sales tax credit for prior year purchases or purchases earlier this year?
Okay, so if it qualifies, you'd have to look at where the item was purchased from. California for sales and use tax purposes differentiates who you can go to for the refund. If it's what's qualified as a sales tax transaction, which is an item that was purchased from a California vendor, you have to go back to that vendor. You would provide them with a completed exemption certificate. They may ask you to provide a letter as well that basically states something to the effect of, we qualified, didn't realize it, here's our exemption certificate after the fact. If it is a purchase from an out-of-state vendor, or if you have reported it on your use tax, your California sales and use tax return, you're able to go back to the state and request a claim for, or put in a claim for refund. The Board of Equalization's website does have claim for refund forms that you could use, as well as those exemption certificates. Be aware if you are going back to the state. So with the use tax, you could either go back to the vendor or you can go to the state. It's with sales tax, you can only go to the vendor. If you are going to the vendor, be prepared to, or if you are going to the state, be prepared to have your documentation in place as to how you qualify, how the item is used. And if it's a significant amount, probably over $10,000, you will likely be audited by the state. They like to offset any amounts they can. Less than that, and you're probably fine.
Great, thanks, Anna. The next one is for Travis. I talked to another firm that wants to charge a contingency fee based on the amount of credits they find for me. Do you charge a contingency fee? If so, what percentage do you charge?
Yes, I've heard that question come up quite a bit. I think there are a lot of firms that charge a contingency fee based on the amount of credits that they calculate. We don't work that way. What we do is we like to talk to the companies, the clients, and really identify what all of their key issues are, and build a work plan really from the ground up. We try to figure out how much in credits are there, and really how much documentation that we need to have in place to adequately support those credits. And we charge based on hourly rates. So if we talk to somebody for 30 minutes to an hour, we can get a pretty good idea. Maybe we request some information from the client, just some preliminary info to get a good handle on it, and figure out how much time we really think it's going to take. And so that's how we approach the pricing of R&D studies.
Great. The next one is again for Anna. Just I think a clarification that it's only for California companies that have gross sales under $2 million. Is that correct?
Oh, this one of the calc. I believe this is on the CalCompetes. Is where the question is applying to. So that's small business. So CalCompetes, anyone can apply for the CalCompetes income tax credit. Big companies, small companies, everyone. The $2 million, what that has to do with is that 25% of the CalCompetes funds are dedicated solely to small businesses. They want to make sure small businesses had the opportunity and weren't pushed out by the larger companies. So 25% of that $75 million solely for a small business. Anyone can apply. Anyone in California doing business or looking to grow or expand can apply for the CalCompetes.
Great. Thanks, Anna. And the next one I can take, does your team have experience defending the credits when they are audited? For the R&D credit, it is audited very frequently, as Travis mentioned in his presentation. We have 2 to 3 new exams pop up every couple months. It's a big issue right now. We do have a lot of experience in defending those, really since 2008 when it became a top priority issue with the IRS. Depending on the examiner, they focus on different things. They like to have adjustments. It is a challenge to get no changes at field exam level. Many times you have to go to appeals, but we do have a lot of experience in defending those. And the next question is again for Anna. And you may have covered this because it came in kind of early in your presentation, but are computers considered equipment?
Yes. So it all comes down to where you're using the computer and how it's being used. The computers are definitely equipment. It's right now there is a little bit of a conflict in the regulation. The way the law was written is that it said anything had to have a useful life of 1 year or more, and it refers to the IRC tables in determining that. However, the way the regulation was written is right now the board is holding that you actually have to depreciate the item. So it's not good enough that it has a useful life of at least 1 year. You have to have it on your depreciation schedules. The board is currently trying to change that. There's a little battle going on internally to get it so that something that is generally understood or is within the industry is generally understood to have a useful life or is intended to have a useful life of at least 1 year would qualify. What they're really trying to exclude are consumables, things that maybe a blade that lasts a few months or a few hundred hours, lubricants. It's funny because it's actually a lot of things that qualify for the federal R&D credit. The consumables, labor, things like that don't qualify for the partial sales and use tax. So they actually complement each other well.
Great. Thanks, Anna. Travis, for the next one. Can I apply the credit against payroll for all employees or just R&D employees?
Yeah, it's interesting. This one, it's not really obvious, I think, when you first look at the rules. But once you dig in, you read through some of the new rules and the committee reports, and you understand really what the intention of the credit was, it is pretty clear that you can use the payroll tax offsets against all employees. So you're really looking at your company's total payroll. And again, you're paying 6.2% on each employee up to that wage base of $118,500. So it's just over, up to $7,000 and some change for every employee that you have. And so we're just talking about the employer's portion of Social Security tax. And so I think that answers that question. Then also on going back to Anna's on computers and R&D, this question comes up a lot too for R&D credits. Some people want to know if the computers they purchase for employees, if those will qualify for the credit. In most cases, the answer to that is no, because the computers are considered depreciable property. However, if you are leasing computers off-site, which most of the times are going to be lease servers, you're leasing server space. So like a cloud service provider like an AWS, those costs could qualify if they are directly supporting your research and development efforts. So if you can really segregate those R&D related costs from the production related costs, then some of those could potentially qualify for the credit.
Okay, great. For Anna, the slide said that items must have a useful life of at least 1 year. Does that mean I have to capitalize the item to qualify for the exemption?
Currently, yes. So I think as we mentioned, that's probably a little bit of a repeat question. But as I did mention, as of right now, the Board of Equalization, when they do audits, they are holding that the item has to be on your depreciation schedule. They're hoping to change that. It may take a few months, and at least when they were talking earlier, they do want that change to be retroactive. So you can always, you got a choice. I mean, you could always not claim it if you don't depreciate currently, and then keep an eye on the updates of the Board of Equalization, and if that does end up passing or changing, you can always go back and put in a claim for refund either with a vendor or with the state, or you can always be aggressive and take a position that it's going to qualify. However, if it doesn't pass, you then would be liable for the additional tax on that amount. So as of right now, yes, it does need to be depreciated. It has to be on your depreciation schedule, but we're hoping that will be changing in the next few months.
The next one is for me, is there a cap on the amount of eligible small business credits that you can use to offset AMT? There is not a cap on the amount of credit or on the amount you can use to offset AMT. The cap is just how much credit you have and how much tax you have in total. It's unlikely, unless you have tax liability less than $25,000, that you would bring your tax to zero with the credit. But if you are under the $25,000 in tax limitation, then you could bring your tax liability down to zero with the credit if you had enough of that in credit. The next question is for Travis. What happens if I do not use all of my payroll tax credits?
Yeah, so we've seen some scenarios already where that may be the case. So let's say you have a large credit, but you don't have enough payroll tax to absorb it all, especially in one quarter. So the way it's going to work is, the excess, the amount that you can't use, is really just going to carry over to the following payroll quarter. And so you're going to have those credits there. They're going to keep rolling forward until you completely exhaust them. So that's the way it's going to work with the carryovers.
Okay. I think we have time for one more. How early in the process should I let the construction contractor know that I want to claim an R&D exemption? This goes to Anna for the California exemption.
Well, when it comes to construction contracts, you want to let them know as soon as possible. So when it comes to sales and use tax, construction contractors are taxed very differently from state to state. But the way California does it, it's based largely on the type of contract you have. And so sometimes a contractor is considered a consumer, meaning that they're not selling you the item, they're buying it for their own use, and sometimes that contractor is considered a retailer where they're actually selling it to you. So a lot of the materials, items, piping, things like that would be considered materials, and the contractor needs to know so that before they give you their bid, they built into their cost estimates that they'll be paying a reduced sales and use tax on the materials they're buying for their own use. So obviously the sooner you can let a construction contractor know, even if you're not absolutely positive, but that contract, if it's not done the correct way at the beginning, you either have to go back and do a change order or redo the contract. So if you're doing any type of construction, you think you may do some type of construction, I definitely have open communication with your contractors.
Great. And that brings us to time. Here's a link for a survey to complete, and that concludes our presentation. Thank you for joining.
Great. Thank you, Star, Travis, and Anna, for a great presentation today. As a reminder, if you attended today's presentation in a group and would like to receive CPE credit, please download and complete the group attendance sheet from the Slides and Handouts widget at the bottom of your screen. If you participated as an individual and met all certification requirements, your certificate is available to download now from the certification widget. Open the icon and click the certificate image to begin the download. We'll email a copy of your CPE certificate in 2 weeks. I'll leave the console open for a few minutes now to allow time to download your CPE certificate. And as Star mentioned, here's a link to an online survey where you can provide feedback for today's presentation. Please take a moment to complete this survey, as your feedback is very important to us. Thank you for joining us, and we hope you'll join us again next time.